Well, welcome everybody to the Finance Magnets Virtual Summit 2020. This is a historical summit because it brings together a great deal of skill, knowledge, experience, which certainly in my lifetime is unique. I'd like to welcome my panelists who are going to make a fabulous contribution, and it's a real privilege to have them on here. So I'm going to ask everybody to introduce themselves in a minute or less, and their companies and their positions, and then we can kick off in terms of that. So Dave, may I invite you to kindly introduce yourself and your company, please?
Sure. I'm Dave Cooney, co-founder of mahifx. It was a company that grew out of time at Barclays Capital, building out Barks. And we decided in 2011 to leave Barclays and go and set up our own business, where we wanted to build the same sort of technology we had at Barclays, but license it to people, putting the technology for price formation and risk management closer to where the business was being sourced. So we now license that technology to banks and brokers, the idea being to help them with rate formation, risk management, and also analytics.
Great. Thank you very much, Dave. Welcome to Michal. Would you like to introduce yourself as well, please?
Hello, everyone. So basically, I'm working for xopenhub. This is the institutional arm of the XTB group. As the XTB was developing the business, we saw that there is a demand on the market on the newest technology. So we built up one for ourselves that's helped us growing and build the business internationally. So later on, we decided to resell our technology, as it was very unique, I would say, and of course, UX friendly for retail investors. Therefore, we decided to open the institutional arm xopenhub, and together with that, as XTB grows in power, we've got our liquidity pool, which we are offering towards our institutional clients.
Thank you very much, Michal. Mr. Guy Hopkins, may I invite you into the arena, please?
Hi, I'm Guy Hopkins. I'm the founder of Fair Exchange. Before I set up Fair Exchange, I was at Morgan Stanley, where I ran the European FX sales business. So Fair Exchange specializes in data analytics on microstructural execution around FX trading. We exist basically to facilitate dialogue between takers and makers of liquidity to help both sides get better outcomes. So it's very much with regard to kind of a detailed view into people's trading data.
Great, thank you very much, and a very warm welcome to Jeff. Would you like to introduce yourself, please?
Hey, I'm Jeff Wilkins. I'm Managing Director of IS Risk Analytics, part of the ISM Capital Markets Group. We work predominantly on the IS Risk Analytics side with retail brokers and help them optimize their books and help them optimize revenue. We're the world's largest risk management firm on the retail brokerage sector. We're NFA regulated. I think we're the only NFA regulated CTA advising brokers. We offer a full risk management suite, including our bridge, our risk management engines, and our award-winning 24-hour risk management desk. It's an advisory service that you could think of it as us just basically sitting in a seat with risk desks, helping them, guiding them through the day, guiding them through the night, 24 hours a day. We are a very data-driven organization. I've been doing this since about 2005, and I'm excited to be here today. Thanks.
Thank you very much, Jeff. And last but not least is Richard Barton. Richard, please introduce yourself.
Thanks, Rafa. My name is Richard Barton. I'm part of the market data team in EMEA for CBOE. CBOE, which some of you may be more familiar with the letter CBOE, is a very large and diversified group of exchanges, renowned for our derivatives business, but also we have a strong franchise in equities. We acquired the old BATS business in the US 4 years ago. They run what is now rebranded as CBOE US, a series of equity markets in the States, and also they run the CBOE Europe market, the largest MTF, and in fact the largest pan-European equity exchange in Europe. We also own assets in the in the currency space and also in the indexes space. And my role, along with some team members in New York and London, is to help commercialize those market data assets.
Great. Thank you very much, Richard, and a very warm welcome to everybody who's joined us as well. It's important that you know we can interact with you, and you can also get into contact with any of the panelists, including myself. The panel is all about really how we define assets, liquidity, and data. And in my view, one of the things I wanted to kick off with is that data is liquidity, and liquidity is data itself. So one of the things, really, the first thing to ask you is that if we look at the trading cycle today, how do you all analyze in your own way, in your own skills and offerings, what this trading cycle is? How has it changed? Has there been a compression of time? Has there been a loosening of the flexibility towards the engineering side of things? So I'd like to start off really with Guy on this, because and I do that deliberately because you are from a firm that you've started, and a firm that is very active in the market rather than a service provider alone. So I'd welcome your views on that, please.
Yeah, I think the first step is really to try and achieve a kind of a common frame of reference. And this is particularly challenging in OTC markets, and particularly foreign exchange. It is highly electronic, but the most important thing in order to improve performance for all concerned is to basically be able to have a meaningful conversation with your counterparties around that performance. And FX in particular has, until relatively recently, lacked that kind of common language for discussion around execution performance, because fundamentally it is OTC. Different counterparties have their own ways of managing P&L and measuring P&L. Over the last few years, however, there has emerged various techniques that actually were pioneered by the likes of David at Barclays for measuring flow quality. And this probably started around kind of 10 years ago or so in the banks, and has steadily kind of percolated out across the broader community about ways of looking at flow quality. And that kind of familiarity with that language of execution quality has allowed participants to have a more meaningful discussion around dialogue around performance. And it's particularly important given that the margins are so tight in markets like foreign exchange. It's very, very easy to tip from making a bit of money to losing lots of money. So, the starting point is using data to have a meaningful dialogue, but that's got to be using an objective framework, measurement framework, for counterparties to agree basically where their starting point is, and then they can work together to get better outcomes.
And that's very interesting. I'd like to bring in Richard at this point, because part of the CBOE stable is Hotspot that you have. How have you interacted because of that? Because Hotspot is a very different type of business than the traditional exchange model or the venue model. We've seen a great deal of a complete changing in what an exchange does. The terminology of market share, competitive issues, mergers, acquisition are now very common, but it wasn't common 10 or so years ago. So could you give us your insight about that, please?
Okay, I'll try. So Hotspot, to be completely honest, is one of the smaller market data assets that we as an organization look to sell, certainly in Europe. Obviously, all of the clients who are market participants on the Hotspot platform are directly connected and receive their own customized view of the liquidity available to them on the Hotspot, the CBOE FX platform. You've got me saying Hotspot now. They won't thank me for that. And that's a reflection of the unique nature, I think, of the FX market data world, in that you get customized liquidity. If we move from that, say, to a more traditional exchange view of market data, you're looking at a data that comes from a public order book. Therefore, everyone gets to see the same view of what is happening in the market. And certainly, especially given the background of the equities side of the SIBO business, the BATS business as was, which is a very technology and still is a very technology-driven business. Obviously, they have also been responsible for pushing a number of changes through into the marketplace from the result of both their business models and the technologies they've employed. Where speed and latency now is critical to all kinds of market participants. That certainly wasn't true, 10 years ago, certainly even 5 years ago. And that's one of the big changes that we've seen is the increasing importance of latency and speed for all manner of market participants. It's no longer just for the banks, but everyone in the ecosystem is increasingly focusing in, not exclusively, obviously, there are lots and lots of different trading and business models that our clients employ, but all of them are increasingly sensitive to a level of latency that they feel they need for their business. And that's certainly the change I've noticed in the last couple of years.
Thank you for that. Just going to Jeff, you've heard from Guy on one end of the spectrum, and then you've heard from Richard on the, if you like, the source, the exchange, the venue part of it. You as a service provider, when you're looking at your risk models, when you're the virtual expert sitting at the end of the desk, so to speak, or with the desk there, what are you seeing in terms of, because Guy talked about commonality, Richard talked about customization, and you have, I think all you, Michal and Dave, have this sort of dichotomy of commonality versus customization. How are you dealing with that?
Yeah, I think Guy touched on it really well. It's about having the meaningful dialogue. We see so many situations that come up at a specific broker that is directly applicable to another broker. Just last night, for example, we saw activity that was hitting a broker in Australia. 2 seconds later, it went to a broker in Cyprus. 2 seconds later, it went to a broker it was an FCA London-based broker. And the fact that we can sit there, everything's data-driven, it's all alert-based on our side, and we can see stuff like that, and we can talk to our brokers and have that meaningful dialogue. It is very systematic on our end in terms of the dashboards and everything we're looking at, but there needs to be the human touch because we are that risk advisor sitting in the virtual chair next to our clients. So, it's important to have the best data possible, the richest data possible, the algorithms and alerts wrapped around that data, and we're constantly evolving on that end. But it's a human touch working with these risk desks and understanding the sensitivities and what their perspective is as well. So I think Guy touched on it perfectly. It's just about having that meaningful dialogue, and it's all, from our perspective, data-driven.
Great, thank you very much. That was a very valuable answer. Michal, do you agree with that, and to what extent do you agree with Jeff's view?
I would say that nowadays, as previous speakers were mentioning, that the market is decentralized. So in many cases, also we as liquidity provider, this is like the advantage or sometimes also the disadvantage of decentralized markets, because in many cases we can come up with tailored offers towards the clients. Of course, I agree with that right now the latency is one of the core issues on the market, together with the time and speed of the execution. Those are the core things when the institutional clients are assessing the liquidity provider. Of course, we are trying to provide with the best features our clients, but one case of the decentralized market is that somehow that market should be also very fast connected, because of many recently seen situations like with oil, for example, or any other flash crashes. The markets and those decentralized markets should communicate in very fast way between themselves, as there should be a reaction, and there's a risk for the brokers that if they are not connected to the fastest, the most reliable liquidity provider or pool of the LPs, they might have the inaccurate data, as well as the liquidity is not basically sufficient for their clients. That's one of the major, I I would say, challenges here as well.
Okay, thank you very much. So you're very much looking at this in terms of the speed angle and the total cost of return in terms of that cycle of trading there. Dave, from your perspective at Mahi, what do you think about what Jeff and Michal have just said in terms of the risk versus not the risk versus, but the risk and the speed element?
I sort of think about it in terms of, we've touched now, I think, on the two things that make being a market make it vulnerable. There's the latency questions, the fact that there's no such thing as simultaneous. And then the other bit that was, the wave of trades that Jeff saw last night was people dealing not full, which can of course be done for effect. Both those things have become endemic, and having technology which identifies that those things are occurring and provides, there's two things about it. One is to kind of mitigate it, or to first identify that it's happened, but that's a little bit looking in the rear vision mirror and saying, okay, we've just had this happen. It'll be nice if we could have some sort of reaction ahead of times to provide some protection for the liquidity provider, so that it's a more fair rate. Because to some extent, latency arbitrage is an exploitation of a piece of information that you have that somebody else doesn't. It's impossible for people to update prices in real time. There's no such thing as real time. So you have to accept that that's a fact of life and just sort of live with the latency, but have some sort of protection around it. The other thing is the dealing not full is tough, because that's a piece of information that the guys trading with a bunch of brokers at the same time have that the individual brokers don't. So it's really a case of identifying that stuff is occurring and then baking into the pricing that people have protection against it, so that the system is reacting automatically, because otherwise it's going to be post fact, a bit ambulance down the bottom of the hill perhaps.
Okay, thank you very much, and some very good insights there. Thank you for that. Jeff, I'd like to come to you in terms of how you employ the so-called TCA in terms of your institutional or be your retail side, because TCA is a factor of risk as well. There's a factor there of risk. How do you and your company deal with that and have dealt with it? Because one of the amazing things that's come out of this pandemic period, as I call it, the crisis period, as happened in 2007-8, is we have a set of unique circumstances, such as redundancies being tested to the limit or not, changes in processes, challenges in procedures, a great deal of scrutiny as to whether all of these regulatory and compliance frameworks work. So there's instant reactions by things. How do you cope with those things when it comes to the TCA debate, please?
Yeah, so what I don't like about our customer base, and I love our customer base, but they don't think about TCA as much as they should be. They're running hybrid models. When they're sending trades to whatever prime or prime broker that they're using, it's a lot of it is a set it and forget it afterthought, and I look at these brokers and the way that they're measuring their revenue, and it's almost what I call a P&L soup. What we're able to do is we're able to identify what the actual risk component of their revenue is and separate that from their markups, their commissions, their swaps, etc. And what we start to help them realize, and I think this will be the theme over the next couple of years, is that actual risk revenue that they're generating is relatively low compared to the rest of the pot. But these brokers live and die and have stressful nights and lose sleep over their just constant erratic revenue returns on a way a lot of these brokers structure their books. So I think TCA is going to be incredibly important once the industry evolves a little bit further and they do understand that risk component being such a sliver of the overall pie. Then once they start to focus on TCA and looking at costs of reject, slippage, and helping them understand that, then they're going to be able to optimize their revenue in a more sensible and controllable way. But I think we are pushing this as hard as we can on our client set and our brokers that we're working with. But I think on the retail sector, the retail brokers are a bit behind the curve in caring as much about TCA. It's very ad hoc right now, which a lot of brokers are, they're asking about a certain transaction, or they're asking about a certain set of transactions. Whereas, once these brokers are able to evolve their business from a risk management standpoint, which I think we're coming up to that new paradigm, then it's going to be so important for them to have a proper TCA solution in place.
Thank you. What you're saying is that the market knows about it. It needs to evolve its thinking and reprioritize, this sort of type of analysis, the transactional side of things. Dave,
sorry, Russ, yeah, so I'll add something to that. I think that's a lot of great points that Jeff's just made. I think when people talk about TCA, I think it naturally falls into this kind of regulatory bucket, and people think about kind of satisfying some sort of kind of regulatory imperative, whether it be MiFID or whatever. And the simple fact of the matter is, this sort of analysis actually stretches right across the business, and it's a commercial thing rather than a regulatory thing. And that's not that has implications for who consumes it, as well as what the actual thing is used for. So, TCA or execution analysis, call it what you will, it shouldn't be the province of a small number of highly qualified individuals, maybe in the trading team. It really needs to be extended right across the organization. That extends to the sales force as well. A good example would be, the kind of firms that Jeff speaks to. Ultimately, if your client is trading in a way that's painful for you, you need to tell them why it's painful. If they are complaining about high rejection rates, they need to understand why do they have a high rejection rate. All these issues crop up through the way that people trade, and the way you help articulate to people how they're trading is through this execution analysis. So it's a much broader subject than just this kind of thing that people think about TCA. Think, oh, we've got TCA in place for our MiFID obligations, whatever it might be. It's completely endemic to the entire market, and as Jeff rightly says, I think it's a long way to go, but encouragingly, people are much more engaged in it than they were in the past.
It's a great point. I see that in my own business. Just to give you an example, my own clients in the CFD industry and so on, that they do two types of deals. They'll do a volume for market data deal, and if your volume falls below a certain amount, then you pay more for market data. So in that respect, there's that sort of TCA, but also it's the flow, it's the quality of the flow of it as well. And I think that's what you're hinting at, Guy, as well. Dave, is this something that you have a total agreement with or a partial agreement with?
Yeah, with both the guys. I think that the thing that seems common in what both Jeff and Guy were saying is that it's easier for people to understand these points that are being made about whether it's you taking too much risk, or that the way in which you present business will affect the way it marks out, and therefore what your spreads are likely to be going forward and stuff. Visualization is key to that stuff, being able to break it down. And so TCA, in my mind, is really about just taking a trade and going, okay, this is what was occurring around the point of impact. This is the post-fact, the post-trade impact. This is possibly why. This is what liquidity conditions were. As much as anything, to educate that there will be consequences to, whether it be liquidity abuse or latency arbitrage or whatever, on the one hand. And then as far as the risk goes, we find it very helpful to run simulations of clients' risk books, the B books, with different risk settings and different parameterizations of the hedges. So you can see in an explicit way the change in the P&L profiles and the risk we measure by VAR relative to what the revenue stream looks like. And some of the results of those have been kind of spectacular in the sense of, like, taking the risk being run to 5% of what it might be previously or less, with on any long run where you get the variation cancelling out, no change in P&L.
It's very interesting.
And it just strikes me as a compelling proposition, right? Because you would have to think that business running with the second regime with the risk controlled is going to be more valuable than the first, because it needs less capital to absorb the swings and all the rest of it.
So really what you're saying is that the practical aspects that Jeff and Guy have certainly given us an insight into has to reverse into what the regulatory and compliance aspects are in many ways. And this is a constant evolution of change in FX. That there isn't any, it's a constant customization rather than a template approach.
Yeah, I guess so. And the thing is, for me, like, it's not even driven by the regulators. I would have regarded it as self-interest to want to have a less volatile P&L series rather than more.
Okay.
If that can be done in a way which is, you know, there or thereabouts produces the same return.
Okay.
You know, I sort of do think that, you know, the Sharpe ratio has some place in risk-taking businesses.
Okay, that's very interesting, because you've opened up a new line of debate there in terms of actually we are okay with the regulatory stuff on this, but there are aspects of things that we do, but the market itself, its own sort of way of doing things enigmatically should be changing towards, but maybe we're just a bit stuck in our ways in some aspects.
I think that might be true. I mean, the thing is, the historic approach of B-booking worked pretty well for a lot of people, but it might have been because spreads were really, really wide, and those spreads would absorb any kind of misbehavior or attempted misbehavior by clients. But as everything tightens up, that's no longer true. But, you know, if you want to encourage people to migrate from one way of doing business to the next, I think you've got to actually allow them to visualize and then use data to demonstrate what those different worlds can look like.
I mean, overall, what I've heard from you guys so far, and I'll come to Michal and Richard in a second here, is that there is inherent value in everything that you've just said so far in the last few minutes, all of you, in that you are talking about data mining just by a different phrase, a different word, you know, whether it's an analysis, whether it's transactions, whether everything is data driven. And the core part of this, and we see this in life as well, you know, we've seen this recently with some of the big social media companies using our data, or their suppliers using data for political ends and think analysis and things like that. But I wanted to see sort of, Richard, from your view as an exchange and market data person, that's very strongly driven by data. Of course, you have a flourishing market data generating business. What is it that you try and provide some analysis in terms to your client base?
So that's an interesting question from market data producing part of a group of exchanges. I mean, as I was saying earlier, we are, if you like, the ultimate source of liquidity, certainly for, you know, exchange traded instruments. We are the source, and so, you know, I guess our job is as much to facilitate the delivery of that data in the cleanest, most appropriate fashion to all of our clients, as it is to then produce analysis on that. Within CBO as a group, we have another division called ISG, Information Solutions Group, that are different to us in terms of while they're data driven like we are. Their job is, as you can imagine from the title, more around providing analytics around the market data that the group generates. I can't really speak for them here, as they're a different division, but certainly, you know, an increasing focus on analytics that we can provide for our customers, you know, is part of CBO's mission in terms of the data and related services that the company is producing. However, from a pure market data perspective, the one thing I would say about the data that we're producing and the way it gets used throughout an organization, be it for TCA or risk management or for any other purpose, is it's important to make sure that, you know, that the data has integrity, not just from an accuracy and reliability and speed point of view, but also from a compliance perspective. You know, increasingly, you know, firms must be aware of the provenance of the data, and also, do they have the agreements in place to allow them to use that data within their organization as they see fit. I think it's a point, Rafa, that you've made before, and it's true here as well, which is, you know, whilst, you know, data compliance may be seen to be expensive, data non-compliance can be much more expensive, both in terms of, but also reputational damage for firms. I think that's increasingly true for retail brokers as it is for other financial services providers.
It is, and this is going to be the next question, but I'd like to invite Michal to give his opinion as well. How are you dealing with the demand for more depth as well as breadth in terms of transaction analysis and other analyses that your clients there? Have you evolved things, you know, in 2020, for example?
Yes, basically, and also I agree with previous speakers that still TCA is the matter of legal and compliance, and of course business aspect. So we as and myself, I'm representing the company that provides the liquidity. So I will tell about the business aspect, which is of course connected with the regulatory aspect of TCA, of course. So we as liquidity provider, we try to be as much transparent as possible. So, for example, one of our tools is to give the transparent order books. We are recording every tick that comes to our systems, and of course, together with the order books. So every time we execute the trades, the client can go backwards and check at what prices and how it was executed. So we are very, very accurate for that. We also have clients that they are using several liquidity providers, and we are providing them with the tools that can measure the TCA in some way. Of course, we are measuring the differences, for example, from the price announced or the price of the executed the price of the executed trade. So, like also the gentleman previously mentioned, that the market is more and more aware of that and focused on the tools that are giving them the possibilities to measure everything in very detailed way. So that's why we are also providing for our liquidity dedicated execution reports, and of course together with the average spreads that we are measuring, average order books. So first of all, we are trying to be as transparent as it's possible, and the second thing is that we are giving the analytical tools for our clients to assess the cost that they may, first of all, have with our liquidity, and the actual cost that they had. So like the role of the liquidity provider is to educate also the client and any trading venue, how the orders are being executed, how they can measure the efficiency of each counterparty here. And like the second thing is the transparency, and the third thing is giving the tools to help them to assess the TCA.
Okay, thank you very much. I mean, what you just said there, if I can paraphrase you, is that you're providing the what-if scenarios, you're providing the historical aspect of actions, and you're therefore giving a third way, which is if we would have done something differently, what would have been the effect on this? So, you know, this is, you know, you've got a historical presence and an evolutionary aspect to your business. So that was very interesting. Thank you. I just want to move on now to market data specifically. And we know that market data is an inherent cost. It is one of life's facts in terms of our business, for sure. We know that there are licenses. So for all my clients, my job is to make sure that they comply with licenses, to get them the licenses, to ensure that they get the best possible usage, and which is very, very underrated. Once they sign it, they just use it usually for one or two things, but there's a whole host of things. So we have the licensing on one hand, we have usage, and then we have to balance that in terms of what Richard was talking about a little bit earlier, was the compliance angle of it, you know, to making sure that we adhere to the spirit of these licenses and what we do. How big a spend, and I obviously don't give figures, but in terms of a percentage or a line item, is it in your top 5, your top 3, your top 10, is market data? And I'm going to exclude Richard for obvious reasons from the answering this, because he's an exchange and so on. So if I may start with your good self, Dave, please.
Well, fortunately, we don't have it. We don't have it as an issue because we deploy our technology to each of our clients and connect to their liquidity. So it's for the clients to make the choice as to who it is that they use and whether it is worth and I'm talking now about foreign exchange, whether it's worth paying the licensing fees to any of the liquidity or the price producing environments. Different world, obviously, in equities, but we kind of take the view that by the time we're provided with the feed, we can rely upon our client to have taken care of the licensing issues.
So that's a great answer, in fact, because what you are first of all in an asset class which is not exchange traded. It's an OTC market by and large. It's off a desk. Each desk, of course, all brokers have different strengths and weaknesses for the basic currency pairings in that respect, but you therefore rely on your clients to make sure that they have the necessary provisions. Is that right? Yeah. So, and that's a great position to be in if you're in a single asset class focus there. In that, Guy, I'm turning to you in terms of that. You will have a wider range of market data coming to you, whether it's through a feed, a terminal, a DMA. How do you deal with the licensing aspect and the usage aspects of that?
I mean, like David, we're kind of pretty much FX focused. I mean, the requirement for market data is usually an operational one rather than one that's driven by any desire to kind of get access to primary markets. And as David has alluded, the central kind of price formation venues, their market data feeds are quite expensive for a lot of participants. So invariably, if customers have problems storing their own market data, and it is quite difficult to store market data, you've got lots of feeds from lots of different liquidity providers. Some people just don't have the bandwidth or the kind of the inclination to store millions and millions of ticks. Then we might need to go and procure maybe a third-party source of reference data to do the kind of performance analysis. And obviously there's licensing associated with that. But as David says, when you really want to give people an understanding of their liquidity, the best thing to do is look at their liquidity. So looking at all the underlying fees that they have is something that does require a reasonable amount of heavy lifting from an engineering perspective, but it doesn't incur any costs. So yeah, pretty much in the same boat as David on that one.
Okay, and do you have any objectives sort of in 2021 to go into other asset classes, for example?
We're asked about it a lot because the kind of firms we speak to, they do FX and something else. So a lot of people ask us about crypto. A lot of people have asked us about kind of CFDs on indices, rates, fixed income, you name it, futures for CTAs. So yes, I think it's something we will definitely look at in 2021. And of course, we fully expect that will incur proper, meaningful market data fees for our customers. But at the moment, it's pretty confined to FX. We've got an awful lot to do in the FX space.
Okay, thank you very much. I know for a fact that Jeff's company, IS Prime, is a large consumer licensing of market data in their different fields for their clients. Of course, the provision of risk is of course dependent upon trying to have inclusion of most market data rather than exclusion. The more data you have, the less you don't have, is the theory. Jeff, to your knowledge, how do you deal with the licensing and the cost base and the usages?
Yeah, I mean, speaking more on the IS risk analytics side, it's not a direct cost to us, but it is a significant cost to our customers. And I look at what's going on in the market right now, and with what's gone on this whole year. The interest in offering shares on a lot of these retail third-party platforms has really peaked this year. And the one thing that I worry about the brokers not thinking about is the market data cost. It's the distribution of data, the liability of that distribution of data. So, Rafa, we probably have customers we should be sending your way to talk to. It's something that these brokers, they look at the next hot thing in the market. It was cryptos. This year it's shares, and they need to think about the costs and the potential revenue with a product like that. So, we always advise our customers to think about the full picture before they jump into a market. I've seen brokers historically over the years, and this was, I would say, the building blocks of the of the industry, the FXCMs, the GFTs, the gains, the Saxos, kind of got caught not thinking about distributional market data, not thinking about distribution to 200,000 retail demo accounts in real time. So, I caution brokers to start thinking about it before they open up a universe of products, and it's incredibly important, and it is very costly if you don't do it the right way. So, it's something that's very important to our customer base.
It is that in 2020, my experience as I've conducted over 200 audits in my career, and market data audits, and this year alone, I can tell you, and I run a graph on this. So in the previous 3 years, I've been involved in 19 audits in total. This year alone, to date, as of yesterday, there have been 34 of them. And these are going to the brokers directly. They've seen, the exchanges are seeing a great deal of value in the data, which is great, of course. They're seeing a great deal of distribution of their data, which is even better, but they're seeing a higher incidence of non-licensed usage. And this is something that is, that I spend a lot of time on here advising, and we've been quite successful in working with people like Richard and so on, because the audit is the last resort, really. And as Richard said, it was a good line he picked, which is, it is expensive to be compliant. It's more expensive to be non-compliant in that respect. Before I get to Richard, can I, Michal, ask your view and how you deal with the market data and how you advise your clients to deal with the market data aspects?
So first of all, I would like to mention that the market data usage and costs are more, like the brokers are more and more aware of that. So of course they are looking for the solution. The question is whether those brokers are thinking of effective way of receiving the market data, because many of the systems right now available to the retail brokers cannot transfer all the ticks that are coming from the exchange directly to the platform. They can think of also the limiting the costs, for example, of presenting, for example, only first level pricing. So of course it depends on the venue from which they are receiving the data. The brokers right now are also looking for some alternative, like for example IX, yes, the exchange from US that is offering market data for free. Some of the clients, institutional clients that we are discussing the market data questions, they are going directly to CBOE to limit the costs of individual exchanges, for example. Yes, some of them are passing the data on the demo accounts delayed by half an hour, 15 minutes. And of course, they are trying to optimize the costs. As for some small retail brokerages, those are quite severe costs. But of course, the bigger brokers are signing the deals directly with the exchanges, which is good for us. We'll get the green light later on to continue the cooperation with them. So more and more brokers are aware of that. So we are happy about it, because this allows us to expand our business with them as well. And on the side of on the XTB side, on our retail side of the business, of course, we've got all agreements in place. So we are aware of that for many years already. And as I can see on the retail side of the business from smaller brokers, like a lot of investment firms from Cyprus, they are aware of that fact. So I think they are assessing the costs of not having the agreements in place.
Yeah, and I actually mirror what you say. Absolutely correct in that, Michal, and it's a very good way. I mean, Richard, you and I work very closely on mutual clients and discuss these issues of licensing very often. What are you seeing, and how are you reacting in terms of the whole market data? Because very often the exchange is seen as the wolf. They're seen as, oh, it's not your data anyway, it's coming from somebody else. You charge us a lot for it, you don't let us do that. that's the uneducated view, in my opinion. But talk us through sort of what the strategies are, and what is the actual objective here of offering this market data?
I mean, I could give a very long answer. I will, for everyone's benefit, I won't. I mean, you know, the clients, basically what we've seen is fragmentation and diversification, both in terms of the types of firms and end users that want access to the market data, the kind of uses that they want that data for, and also the different market data types that they want access to. And so you see this expanded cast of characters and this expanded set of requirements. So that means that, you know, and from an exchange perspective, you know, we're regulated to offer, you know, the same set of access, the same terms of business to all potential participants and clients of the data. So, you know, we can't be all things to all people, and maybe a little different to the FX world, where, you know, I'm not saying they can be all things to all people, but you can customize the liquidity. You have more ability to deliver something specific to a client's requirements. Whereas for us, we have a set of products built from our data, which we can then distribute, which we can then offer out to clients. So we've seen, you know, a lot of diversification there. You know, 5-10 years ago, people just maybe wanted data on terminals. Maybe a few people wanted data feeds. Then web components came in. Then people wanted to white label services. Then people wanted access to. Then there was more non-display as automation took over. And now firms want white labeling of services. And then now firms want access to level 2 data, not just for their own use, but to distribute downstream to clients. So, you know, you have, as I said, an increasing cast of characters. It's not just investment banks and prop shops, as my fellow panelists, you know, can testify to. It's retail brokers and their end clients as well, who increasingly want access to what was seen 5 years ago as almost an institutional data set. And not only that, they want to use it in a far greater array. We're also seeing a lot of firms coming to us recently wanting to put our market data on open access areas of their website. You know, and so they're now looking for pricing models that allow them to put data almost on an enterprise basis on their website in order to attract you know, the new wave of retail investors and traders that we've seen enter the marketplace off the back of the volatility earlier this year. So that's really, you know, some of the trends that we're seeing. And also, as I mentioned, from an exchange perspective, you know, we have a single set of products that we offer to people. So it's a case of trying to marry occasionally these quite diverse sets of requirements with that constraint.
It's very interesting, because certainly you see a lot of that now, where before people were not approaching the exchanges years ago because it would be deemed to be suspicious activity. Whereas today you're seeing the other side of the coin, which is that we would like to do this. We're pumping money into this. You know, what is it going to cost us? What can we do with it? What can we not do with it? So, Richard, I'm very grateful for that précis of this. In the interest of time, I'm going to wrap up with one question to each of you. And you've got 20 seconds or less to answer that. But it's really about 2021 and asking you for your pragmatic predictions, because all of us got it right on 2020, of course. You know, so given the capabilities of our colleagues on the panel, I expect you to have a very low latency and a high ratio there of acceptance. So no pressure on you. So give me a prediction, a pragmatic prediction for 2021 there. So if I'll go around the screen as I see it. So Dave, may I ask you?
Yeah, I think it's going to be you know, getting richer and richer data analysis. So moving beyond just, you know, what happened, and even beyond, you know, why did it happen, to how can we prevent it happening? So if there was a bad trade, for example, why did that occur? What could we have done about it? That's like an analysis. You got to review it. And then the stuff that we talked about of modeling portfolios. Big job, lots of data. But very rich and helps expose the trade-offs between risk and return, the Sharpe ratio stuff that we were talking about, which moves the whole conversation on to just higher quality businesses for all of our customers.
Great, thank you very much. That was very, very interesting. A lot said in that. Michal, your prediction, please, and you'll be kept to it, by the way. You know.
So I would say that it depends on the volatility of the markets and on the volumes as well. So this is it, I would say.
Okay. Okay. Thank you.
I think that the in terms of the topics that we discussed, but also in terms of the data, number of the ticks, of the volatility. If the markets will be moving, those topics that we discussed, also PCA and the rest of the points, it will be together with the market data when the interest in the markets is also growing. I would say if the volatility stays a little bit in 2021, it will be for sure interesting here.
Yes, I agree. I think you're absolutely right. Richard, what is your pragmatic prediction for next year?
From my side, I see an increasing push towards offering a multi-asset range of products amongst retail brokers. Some of the panelists have alluded to the fact that their clients have moved from FX and into indexes. Now they're moving into equities. We see more push into exchange traded derivatives happening next year. We're seeing interest from some brokers in US equity and index options. They can potentially, roll those out to a European client base. As a mirror of that, we're launching an index derivatives exchange in Europe next year. So we hope to continue that trend ourselves.
Great, thank you. That's a very interesting thing about the launch of your new service. Guy, please add to this fountain of predictions, please.
I think the future kind of shakes out into kind of three distinct phases. I think there's a measurement phase, what's going on at the moment. Then there's a kind of a simulation phase, which I think Dave has already alluded to, kind of what would happen if we were to make certain sorts of changes. And then the third stage is optimization. What's the best of those things to pick? And different firms are on different parts of that spectrum. A lot of the people we speak to on a daily basis are still in kind of phase one, kind of like what's going on in my business. Some of the more forward-thinking firms are definitely into kind of the simulation part, and kind of the really kind of smart guys, I think, are kind of making their way into phase three optimization. But there's a long way to go there. So I think there's all sorts of interesting stuff that 2021 and beyond holds for this market.
Yeah, that's very nice to break it down. Thank you very much. Well, the sage that is Jeff Wilkins has heard what you all predict. He's going to tell us what will happen now. So no pressure on you there, Jeff.
I'll just touch for a second on where we've been. The last several years have been brokers have been focused on regulatory diversification, making sure they have an abundance of licenses so that they're not captive to one oversight body. And that's been successful. And I think we're at a point now where these brokers really are going to be focusing on risk efficient returns. They have to. And, I think it was Dave touched on it earlier. These brokers have built these businesses. The industry absolutely exploded in about 2011. The number of brokers, it's gone through a consolidation, but there's owners of these brokers who they're looking to cash out, they're looking to exit. And so they're thinking about the valuation of their business. And any sensible outside investor is going to come in, and if the business has erratic month-over-month returns, they're going to devalue that business compared to something that's got a normalized, stabilized revenue stream month-over-month, something that an investor can look at and build a cost basis around and understand the actual value of the business. That's going to increase the multiple. And that comes down to risk efficient returns, and really it has to be a data-driven exercise, understanding all of the components of revenue and optimizing what you can control and mitigating what you can't control. And so I think we're entering that new paradigm. Guy touched on it. Some of the brokers that are a little more ahead of the curve are getting there. They're thinking about that. It's just now up to the rest of the industry to catch up.
Well, Thank you very much. What you just said is really that there is a mitigation aspect of what you can control, but you can't cure, so to speak. And then there is the recurring return and the recurring cost efficiency in that as well. And that's very interesting. It leaves me to thank each and every one of you for your invaluable input, your great insights. Certainly, I've learned so much from this. I'm very grateful to you all. And I want to thank our friends at Finance Magnets for arranging this and making it such an easy panel for me to manage, really. So I'm grateful for you, Jenny and Claudia.